All right. Well, speaking of what's coming and what's scary, America's banking system is teetering on the edge. The Federal Reserve has been shrinking its balance sheet at a rapid pace, pulling liquidity out of the system. Cracks are already showing. Analysts have been warning for a long time that we could see loan losses approaching 100% in key sectors like commercial real estate and apartment complex loans. Again, we've been warning about this for over a year here on the show. Friends of the show like Gerald Salenti and others have been saying this is coming. You need to pay attention. Think about that. Entire categories of loans going bust. This isn't just a few bad bets here. This is systemic. Banks across the country are sitting on trillions in exposure while the Fed is now going to tighten its screws. Central banks are buying up as much gold as they can. It's like a recipe for defaults right now. To help us break down what's actually happening here is economist Peter St. Onge. She's been following this very, very closely. Peter, welcome back to the show. You know, I can't help but think that this feels like the beginning of a 2008 style collapse, or maybe it could be worse this time. Can you walk me off the ledge, or is this what we're facing? This could be worse than 2008.
Yeah, we've sort of been in a permanent 2008 crisis really since the beginning of fractional reserve banking. That's the purpose of central banks, is to sort of bail out the financial system. And what they learned in 2008 is that the best way to do it, you don't wait until it breaks, you bail it out ahead of time. That's really what we saw in 2023. We saw, some bank stress. We had a couple of banks that collapsed. For a minute there in early 2023, we actually had larger bank collapses than we did in the beginning of 2008. The thing is that the system kicked in, bailed out everybody, right? The Fed came in with their, they essentially loaned banks based on fictitious asset values. They've got all these little backstops in there so that they can bail it out without anybody seeing it. Now, what is a concern at this point is that system is, sort of patched up with duct tape and baling wire. And it's been holding together for the past couple of years. It got a little bit ugly in 2023, but indeed they bailed it out. They got it out of the headlines. The concern right now is that what happened during COVID is that the Fed just flooded money into the system. This is really all central banks in the world did the same thing. And you remember during Bidenflation, people were like, no, yeah, Europe's got inflation too. It's the Suez Canal. It's the supply chains. No, every bank in the world flooded out capital. Of course, that raised inflation. And so what all banks in the world did, but specifically the Federal Reserve, is they started draining that capital out. So that's something called quantitative tightening, right? Quantitative easing is when the Fed just prints money and buys everything in sight. That's kind of a Wall Street bailout. It doesn't get the headlines. QT is when they do the opposite. So they let assets roll off the Fed balance sheet. The Fed at one point had $9 trillion on its balance sheet. It's more than all the companies in all of America. So it's been letting that roll off and then canceling the dollars. Now, it did that in order to break Bidenflation, which it did. That is how you break Bidenflation. The problem at this point is that they're still about $3 trillion heavy. Okay, they have roughly $6 trillion in assets sitting on the Fed balance sheet. And they know that that's disruptive to the system. They're trying to sell that off in quantitative tightening. The issue is that drains reserves out of the system. That drains money out, that kind of lubricates things, right? It goes for interbank loans. And so, to sort of give a flavor of that, there's something called reverse repo, which is where non-bank entities, including hedge funds, park money at the Fed and they get interest on it. That was a huge source of reserves of the past couple of years. At one point, it was north of $3 trillion. That is now down to $32 billion. So what's got people concerned is, A, we're draining liquidity out of the system. We actually know what happened last time. That was the so-called taper tantrum back in 2018-19, right before COVID hit. Yeah, we had some financial drama. Interest rates were spiking. The Fed had to jump in. The question at this point is, are we going to see a repeat of that? More important, the Fed does not really have models that estimate what's going to happen when you drain all of that liquidity out. So that puts the Fed, they sort of painted themselves in a corner. They have to do this QT to pull all the money out that they printed during COVID, or else that's going to continue pumping inflation. But if they pull too much out, their concern is that they're going to break something. What's most likely to break is something that a lot of us have been watching for really the past 2 years, which is commercial real estate. So there's something like between 700 billion and 1.3 trillion in commercial real estate that is in distress. It's in distress for a couple of reasons. One of them is because the Fed yanked interest rates. They made them so low, then they made them so high. That meant a lot of property, a lot of investments got made, which are only tenable at those low interest rates. And of course, those are long gone. We have high interest rates now. That means that a lot of developers, they have to take projects that could only work with 2% money. Now they have to make it work with 8% money. So that's one issue. That's the so-called cliff, the maturation wall that we're facing. The other issue, of course, is that the economics of commercial real estate changed during COVID. It changed because a lot of blue cities fell apart. You know, they had riots, BLM riots, which the police were instructed to stand down on. That raised the risk. Also worked from home, so an enormous number of people left the office. Now, companies are to a certain extent reversing those work from home policies. They're telling people come back to the office or you're gone. But there are also a lot of companies that change their structure because it is cheaper if everybody can work from home for certain industries. So we've had a structural reduction in office demand. We've had a specific reduction in cities like San Francisco or New York, where a lot of companies just said, screw this. I'm done with the homeless. I'm done with the riots. I'm done with the street crime. I'm going to take things out. Maybe I'm going to take them to Florida or somewhere. And you don't have as much legacy property in places like those. A lot of those projects are brand new. So that's the concern, is that we can see a lot of those properties fail. Those commercial real estate loans are disproportionately in small community banks, which are weaker to begin with. They don't have the too big to fail permanent bailout that gives larger banks a competitive advantage in raising capital and in risk rates, which is all backed by the taxpayer. But anyway, it exists. So that's the concern, is that we can see this cascade where commercial real estate breaks, community banks break, and then when you've got that combined with this eroding capital buffer across the entire economy as the Fed drains out, we could see something that at least is as bad as 2023, could be worse, more towards 2008.
Jeez.
Now, something I've been wondering about is President Trump continues to put pressure on the Fed to lower interest rates because he wants more money to circulate. But we all know that you don't get both. You either get a low rate or a low price. And so if we get that low rate, we're going to see prices of homes skyrocket. And something that Marjorie Taylor Greene has said repeatedly is that young people can't afford to buy houses. So that's not going to solve this bit. What happens? I mean, it seems inconceivable, but could this push housing prices even higher? What would that do to the housing, the primary home market?
Yeah, they absolutely could. So you're right. Traditionally, when you lower interest rates, house prices go up. When you lower interest rates, everything goes up. This is why boomers are so rich, because the Fed handed them their $1 million retirements. But specific to housing, housing has really been a mess the past couple of years. And again, this goes back to the Fed yo-yoing rates, right? So if you push rates to near zero and you keep them there for a little while and then you suddenly yank them up, right? The Fed increase of interest rates over the past couple of years, that was the biggest since the 1970s. Right, so that is disruptive to all kinds of things. It's disruptive to community banks, to commercial real estate, but specifically to housing, because what it does is that people in. So somebody might have bought a house in, 2021. They might have bought it at 3% mortgage. It was expensive back then, but they could afford it at 3% mortgage. The problem at this point now is that home prices have gone up about 40% nationwide, but because the interest rate on mortgages went from, 3.25% to, now we're roughly 7%, people are priced out of the market. And the issue is that when you lower interest rates, historically, that makes house prices go up even more. The question is, when we unstick this frozen market, right, when we've got all these millions of people who are locked into homes where they can't afford to sell and get a new 7% mortgage, when that unsticks, nobody really knows exactly what's going to happen. We've seen a couple of indicators, such as the number of home sellers. There's about 500,000 more sellers than buyers. That's the biggest disconnect since the wake of the 2008 crisis, so about 2012-13. What happened back then is prices did fall. They didn't fall much. They fell by about 7 to 10%. The magnitude at this point is larger. Also, remember back in 2012, we just sort of cleaned out a lot of the deadwood in the market. Not necessarily in a good way. A lot of people lost their houses. But anyway, we had sort of repriced things in the market. which we haven't done at this point. So it could be larger than that. But I think really the confusion in home prices that if you look at the projections from Zillow and Realtor, the National Association of Realtors, nobody knows what's going to happen. People just kind of put their finger in the wind and say, I guess it'll go up 1% or 2%. Nobody has any idea because the Fed so screwed up the market with the interest rates. And now, of course, Trump is a developer by instinct. He loves low rates. If you're a property developer, of course, you love low rates. It makes your projects profitable. So he's always going to be pushing for that. And, we sort of, of course, at this point, we have a larger question, which is Trump going after Fed independence completely. During the campaign, he criticized the Fed as an institution. The trick is always that when you're out of power, you're going to hate organizations like the Fed because they're, being controlled by Biden people. But once you're in power, it's extraordinarily tempting to go from abolishing these institutions to using it for yourself. And so it looks like at this point, that's very much what Trump wants to do. It doesn't necessarily drive inflation, and the reason goes back to that quantitative tightening, right? So if the Fed continues essentially selling assets and canceling the dollars, that could theoretically put a lid on inflation, even with low rates. But you're absolutely right. As far as housing goes, historically, house prices go down when you have this kind of excess seller market. Really, nobody knows what's going to happen at this point. And if inflation takes off again because of those rate hikes or because of those rate cuts, then absolutely, it could be even harder for young people. There was a statistic, I actually just posted it today, where 50%, let's see, in 1970, 50% of 30-year-olds had a house and they had a family, they had kids. Today, that's down to 14%. I mean, we have completely destroyed. That's 30 years old. That's not 23 years old, right? That's 30. Traditionally, that's when you were grown up. Not anymore. People cannot afford it.
With the 30 seconds we've got left, Peter, are banks already technically insolvent and we're just not being told about it? They're hiding it from us?
100%. Fractional reserve means banks are always insolvent. That's the reason why they create central banks, is to bail them out. The godfather of central banking, Walter Bagehot, said that very, very clearly. They don't even hide it internally. They don't write it in the newspaper, but yes, they're 100% insolvent. When your grandma puts her money in the bank, she thinks the money is in a vault. It is not. It is relent to hedge funds in, Indonesia or something. The money ain't there. So this is a fundamental issue in central banking, is that, the reason why they jawbone, the reason why they have late Sunday night, conferences reassuring everybody that the banks are safe and then they collapse. The reason for that whole smoke and mirrors is because it is permanently insolvent.
Right.
Economist Peter St. Onge, always an education.
In uncharted territory, we are.
Yeah, unbelievable.
We are.
Peter, great to see you. Thank you so much. Follow Peter's great work. Follow him on X and follow his great show. Always great to have you here, Peter. Thank you.
Great to be on. Thanks, guys.
We are in an enormous breakout cycle for my favorite metal, which is silver. If you've watched my show for any length of time, you know I'm a big investor in silver. And I'm about to share with you my #1 all-time pure silver idea for the coming decade. So I'm not beating around the bush on this, okay? This is it. One billionaire mining tycoon has just increased his position in this particular silver company that I'm very bullish on. On top of that, a prominent Argentinian businessman who's already invested millions in May of this year just raised his personal stake once more by millions of dollars. Just 2 weeks ago, he did that, which is the reason I'm profiling this company to you again right now. The momentum is huge right now. Together, both of them own roughly a quarter of Argenta Silver, which is available on Interactive Brokers you can check out. So as you know, on Friday, silver hit $40 an ounce, a 14-year high. Guys, that is a generational level high. This has only happened twice ever in silver's history. And then when that happened, it shot up to $50 an ounce. Meanwhile, Wall Street's Bank of America is forecasting $4,000 an ounce for gold. Many are even more excited about silver. So Argenta Silver is my #1 silver company. And since I showed it to you back in May of this year, the company's share price has appreciated by 140% in just over 90 days. So hopefully you were paying attention when I first told you about this company back then. You can clearly see for yourself this is a huge breakout. I hope you paid attention back then, back in May, because if you did, you can see they're up over 140%. So I told you this was coming, in my opinion, back then. Now, the dollar is trading right now at its 3-year support line. I personally cannot think of a better time to highlight Argenta Silver's business model to you. So here are my top 3 reasons that this company is currently my top silver play for the next 10 years. First of all, 2 highly successful businessmen with proven track records in mining are buying millions and tens of millions of shares of the company. Both Frank Giustra and Argentinian real estate entrepreneur Eduardo Elstein, who has acquired 25 million shares in March, are major shareholders of Argenta Silver. Just 2 weeks ago, they both purchased additional shares, again, putting millions of dollars into this company. Look at the screen right here. And the valuation of the company, here are the dry figures which tell the story. The previous owners of the El Cuevar silver mine spent an estimated $60 million Canadian on the project, discovering the 3rd largest pure silver deposit in Argentina, and they built a 100-people camp there. Then Argenta Silver came in, purchased the project for only $3.5 million US back in September. Huge. The pure silver deposit contains a silver resource of 45.3 million ounces in the indicated category, 4.1 million ounces in the inferred category. And you can read the technical report for yourself below. I will have it linked below in the description. Dive into all of the details yourself. They are public. I encourage you to do the research on that. But here's where it gets really good. Less than 1% of the project area has been explored. So I cannot overstate the potential here. This is already the 3rd largest undeveloped pure silver deposit in Argentina. We have a silver shortage around the world right now, and Argenta Silver now has a significant cash position, roughly $18 million in working capital, and they are drilling as we speak. So results are imminent and will continue to come in for the next few months. Remember, this project was dormant for over a decade. So this drilling program is critical right now. So again, the ticker on the OTC market is right here on your screen, AGAGF. This is one of the reasons that with gold hitting a historic all-time high, that with silver just hitting a 14-year high, a generational high this weekend, with also Argentina's most prominent businessman, Eduardo Elstein, with a track record in mining, investing $7.5 million in Argenta Silver, with billionaire mining magnate Frank Giustra calling this project a vehicle to fulfill a 40-year dream of his to scale a pure silver company. I'm featuring it to you today, and with President Trump's big moves on minerals. So it's all coming to a head right now, in my opinion. So guys, do your own homework on Argenta Silver. Again, here's the ticker on your screen. Like I said, this really matters to me on a personal level, that both Eduardo Elstein and Frank Giustra have been buying millions of shares of this company in 2025. And Frank Giustra is a legend in this business. He says that their silver resource is a once in a 40-year opportunity. So again, guys, do your own homework on this company. I'll have links to the company's information in the description below. And I hope to see you next time. Happy Labor Day. This country is changing forever right now. We'll see you next time.